This is probably going to be the most important video that you'll watch in your whole trading career. And I've compiled the 8 most important lessons that I have learned after 15 years of being a trader, but also what I've learned mentoring hundreds and hundreds of traders over the years and following the traders going from losing to profitable traders, and many even kept on going to become funded traders or just self-employed professional traders. I really urge you to watch the video, and if you understand the concepts and the principles that I'm about to share with you, this will have an impact on your trading that you won't believe, and it can really make the difference between winning and losing. And this is the rough path of this video. We're going to first talk about the win rate and the components of win rate thinking. We learn about how to control your win rate. Then we will move over into the probabilistic mindset that is so important as a trader. I will share with you what is the real holy grail in trading, and then what is the #1 realization that is causing many traders to have an aha moment and put them on the track to professional long-term trading. So I want to start with the core, what is win rate, and especially this is the key, sample size thinking. And I want to start pretty basic so that we are all on the same page, and then during the video we will slowly progress through pretty advanced concepts. But let's start here. And when we boil it down at the core, what is win rate? What do we mean by win rate? And of course, many of you will know what it means, but let's repeat. The win rate tells you how many trades you won over a certain amount of trades. And we can use that number as a reference point for future decision making. So here is our first example. Let's say over the last 50 trades, your win rate is 60%. How are we going to use that now? Because right now it's pretty abstract. But let's assume that in the next 50 trades from now on, I would expect my win rate to stay roughly the same. It can be maybe 65, it can be 55, but it should stay roughly in the same ballpark. If I follow the same rules, if I follow the same strategy, and the market doesn't fundamentally change. But even then, because this is the key, sample size thinking, even then, even if the market changes, I would expect to not have this a huge impact on my win rate, because 50 trades is for the most part a pretty long duration. So we're gonna hopefully in those 50 trades be exposed to different market periods, to different market phases, so that maybe some of the time our system performs better, maybe other times the system performs not as good, but overall we should roughly get to this same number. And the longer you look back, if you look for example at the last 100 trades or your last 200 trades, and you look at that win rate is then even more likely to stay roughly the same. Okay, so far so good. Next. And if then in the next 50 trades your win rate is higher than 60%, then we need to ask ourselves and we need to verify, did the quality of my trading improve? Because we really want to understand what caused our win rate to go up. Why are we suddenly realizing more winning trades? Because that can be a very important insight. Maybe we can learn something about some approach or some rule change or whatever we did differently that is causing our system to perform better. Did I change my rule? Did I change my trade approach? That's very important that we then learn and understand that this can be a very important insight. But also on the other hand, if in 50 trades my win rate is lower and maybe we go from 60 to 50 or 45, we need to examine that, and this is very important because we need to ask, did the trade quality suffer? Which means, did you break your rules? Did you take trades that are not in line with your strategy? What has changed? What was different than in the 50 trades before that? So this is one thing where the win rate comes in very, very handy, and it can already help you to get a very different view in your trading, but it also can help you just look at different components of your trading. Next, another example, how are we going to use win rate and this sample size thinking? Second example, so again we stay with a theoretical win rate of 60%. And we can use that number to get an estimate for how likely are losing streaks in the future. So 2 losses in a row, if we take 40% and multiply it by another 40%, because that's the loss rate, which is the opposite of the win rate, we get 16%. 3 losses in a row have a likelihood of 6.4%. We get there by multiplying 40% times 40% times 40%. And 5 losses in a row have a likelihood of 1%. So what we do is 40 times 40 times 40 times 40 times 40. I hope that was 5 times, and then you get to 1%. All right, so far so good. But what are we going to do with that number? And we can use that for our position sizing, for example. So let's look at it. Knowing this, we can adjust our position size based on the drawdown that you are willing to accept and also ready to handle emotionally. So let's take a look at what this means. If we risk 2% per trade and we lose 5 trades in a row, you will be down 10%. 5 trades, each 2%, 10%, not too hard. If we risk, on the other hand, 5% per trade and we lose 5 trades in a row, you are down 25%. Okay, and having the certainty that you will lose 5 trades in a row, because there's not a question if we will lose 5 trades at one point, there will be periods where we're gonna have 5 losing trades, 6 losing trades, 7 losing trades in a row. And there's nothing you can do about this. This is pure math. You have your win rate system and you look at the numbers, and the numbers tell you what is likely going to happen in the future. And you have to be ready for losing streaks with 5, 6, 7, 8 trades. And 1% chance to hit 5 losing trades in a row is not very small. This will happen time and time again. So ask yourself, how would you feel if you would be down 25%? Do you feel comfortable with that? If the answer is no, then 5% per trade is way too high for you and you should scale it back. Can you handle 10% down on your account? Then okay, if that's the case, maybe 2% per trade is right for you. And you can do the same for 6, 7, 8 losing trades. There will be times where you hit those losing streaks, and you need to make sure that if you get there, or rather when you get there, that you can handle it emotionally and that you can come back for it. And also, what does it mean for your goal as a trader, your long-term goal? For example, when I mentor a trader and he has aspirations to trade OPM, other people's money, and we're going to cover that in a later part of this video. This will probably be unacceptable if you have other people's money and you manage that. If you hit a losing streak, or rather if you have a drawdown of 25%, you can be sure that there will be questions asked, and you can be sure that this doesn't look good on your track record. So that's also something to consider. And those are very, very important implications that you have to make sure that you understand. And the win rate, on its own, the win rate is not very helpful. It doesn't say a lot. But if we look at what are the impacts and what are the areas that the win rate is helping us to understand as a trader, and where can we use that? Position sizing, for example, or later when we look at trade expression, controlling our win rate. That is really where it's a very important metric. Here are a few very important insights about win rate. And there's a huge issue with win rate. The win rate is a long-term variable, and it doesn't say anything about the next trade that you're about to take. And this is where we slowly get into the probabilistic mindset and statistical thinking. So when you know that over your last 50 or 100 trades, your win rate is 60%, this doesn't help you at all to make any assumptions about what your next trade outcome is going to be. So let's assume you have taken 100 trades, and if you look at the 100 trades, you had a win rate of 60%. And now you're about to take a new trade. How likely is the trade going to win or lose? You have no idea. The 60% doesn't help you at all. And that's where it gets slowly very, very dangerous, because we have to understand that every trade is independent than the one before. It's like when you throw a dice. If you throw a dice and the last time you throw the dice, one came up, it doesn't make one more or less likely if you throw the dice the next time. And this is exactly what happens with trading. Even if your last 10 trades were all winning trades, it doesn't make the next one more or less likely to be a winning trade, or a losing trade for that matter. And this is so, so important to understand. A single trade is independent and random. And we don't know in advance what the outcome will be, right? If we would know what the outcome would be, trading would be quite simple. But we don't know that, and this is so important. And this has implications for your position sizing. So many traders make the mistake, if they're in a losing streak, let's say you have hit 5 losses in a row, and you maybe think, okay, I'm overdue for a winning trade, and then you risk more than you should. And obviously that leads to very bad outcomes because you don't know what the next trade is going to be, and you're not overdue for a winning trade. That is just so important, and I've seen many traders who make that mistake. This is probabilistic mindset introduction, and we're going to go more in depth on this, but this is very important to understand. So do not adjust your risk based on your previous trade outcome, and always apply position sizing with the bigger picture in mind. What I just talked about, the likelihood of winning streaks, the drawdown, the significance of drawdowns, that is very, very important to understand as a trader. Many traders, when you read the common or the most popular trading books, when they ask, how do you define your job position as a trader, many will answer that they see their role as a risk manager. And this should always be your number one priority. Protect your downside, manage your risk, make sure that you can endure drawdowns, make sure that you can just stay in the game and not be thrown out or not be kicked out by making subpar decisions which will put you in a bad spot. So let's talk now a little bit about controlling the win rate and what affects your win rate. And there are 3 main points. First, trade quality. Everything equal, you would expect that the better you follow a tested trading strategy, the higher the win rate will be, right? If you have a trading strategy and you follow all the rules, generally speaking, you would assume that your win rate is better than if you would follow the same strategy, but you break your rules and you take trades that are not in line with the strategy. I think that's quite obvious. Second, experience. The more experience you have with the trading system, the more you will learn about the system and the better you should be able to execute it. However, I see many experienced traders will choose to lower their win rate to improve profitability. So there are ways how we can manipulate our win rate, which we're going to cover in a moment, to realize different outcomes for our trades. We come back to the reward risk ratio in that context. But the key is here, the more experience you have with a strategy, and there also comes the component of journaling, tracking, and analyzing your trading data, the more you will learn about the system and the better you can execute it, which then will obviously mean that generally you should see a positive impact on your win rate. Trade expression. The way you choose your targets, your exits, and your stop placement directly influences and impacts your win rate. And this, I think, is such an important topic that I want to spend a few moments on that. So now let's take a look at a few examples, and this is really important to understand because that is often the missing piece. And I would really urge you to turn on your common sense and follow this. So we have 2 scenarios. We buy a stock at 100 US dollar, euro, rupees, whatever it is, doesn't matter. We buy it at 100. And in one example, our target is at 200, and in the other, our target is at 120. So we want to go from 100 to 200 and from 100 to 120. If we take this trade over and over again, in which scenario do you think the target is more likely to be hit? And of course, the answer is scenario 2. The closer your target is, the more likely is it that the price will eventually hit it, right? This is common sense, but there's a lot of implications behind that. And the insight is that the further away the target, the more you want to make with a single trade, the lower the likelihood that the price will make it. And I cannot stress the importance of this enough, and I've talked about this with many traders, and I'm always surprised of how few even consider this thought. And this has so many implications for your trade expression. Where do you put your target? How do you exit your trades? What is the time horizon that you anticipate for your trade? A lot of traders don't like to hold trades for a long time, or maybe not even like. They cannot hold trades for a long time because it's emotionally challenging to be in a trade for a long time, see your P&L go up and down. But at the same time, they want to trade a trading system where they hit or aim at least for high winning trades or large winning trades. But emotionally, they can't handle this and they don't understand it. So this is the first very important insight. Second scenario. Again, we buy a stock at 100 and we have our stop loss at 95 or 80. So in one example, our stop loss is 5 points away from our entry, and in the other one, it's 20 points away from our entry point. In which scenario will the price be more likely to hit the stop loss? And of course, the answer is the first scenario. If we have our stop loss very close to our entry, the market is more likely to hit it because even small fluctuations will more easily hit our stop loss. And the same applies also to a trailing stop loss. If you move the stop loss very close behind the current price, there's also a high likelihood that you will be taken out compared to an approach where you give the trade a lot more room. And Moritz and I, a few years ago, we held a trading workshop in the Philippines, and he said something so important, and the words really stuck with me. He said, reduce the need for accuracy. You don't have to be very accurate with your entry timing if you just give your trade room to unfold. A lot of traders really want to pinpoint the perfect entry. They want to get into a trade, never see a drawdown, and then just have the trade go on to their very far away target. And as we have learned, shooting for a wide target with a very tight stop loss is just very, very hard to achieve, and not even hard to, it's very unlikely. And that is such an important insight that I cannot stress the importance of this enough. So now we can make the next step into the probabilistic mindset. And I know that some of you will now say, but I had this one trade where I had a very tight stop loss and a large take profit and it worked out perfectly. Or you maybe have seen another trader post a trade where he just made a lot of money on this one trade and everything worked out perfectly. And then you want to replicate that. And I'm not arguing with you at all. There are always outliers. But the goal of this thought exercise and this video is that I want to help you get into the mindset of long-term probabilistic thinking. Because the goal is that I want to help you build a long-term trading career where the results are predictable. I don't think it is really helpful to traders to chase a mindset where they rely on hitting one trade in their whole trading career where everything will work out and one trade will help you to retire forever. This is, I don't think, a good approach because it easily leads to the gambling mindset. On the other hand, what I would really recommend and urge you to get into is to strive to build a trading career where you have predictable and repeatable results that can generate you a monthly income flow of trading profits. And this is the only way to get into this is with this probabilistic and long-term mindset. And here I have collected a few examples that will help you understand how the keyword on average and long-term thinking really plays out in areas outside of trading. So on average, we can agree that men are taller than women. However, that doesn't mean that some women can't be taller than some men. Of course, we all know some women who are pretty tall and they are taller than some men who may be very small. But the key is here that on average, men are taller than women. Another example, my uncle smoked for 60 years and never had any health issues. Does that make smoking not dangerous? Of course not. That doesn't make smoking healthy and generally safe. It is a one single event. Or I drove my car 100 miles an hour through a school district and nothing happened. So if I do this for the next 2 years every single day, will this be safe to do? Of course not. You cannot expect to have the same outcome based on one observation. Or I rolled the dice 4 times and there was no 6. Does that mean that the dice doesn't have a 6? Of course not. And the keyword is here that a lot of traders or people in general, this probabilistic mindset or thinking in terms of statistics and probabilities is not very common, and we are not taught this very well in our education system. And this can lead to a lot of problems because it leads to wrong assumptions about many things, not only trading related, as we can see. And single events cannot explain what will happen if you do the same thing 100 or 1,000 or 1,000,000 times. So let's keep going with this thought process. And you may be able to realize a huge winning trade, and of course there will be times where you can hit a home run, but can you reasonably expect this outcome on average? And here we come to the point of reward and risk. And risk and reward go hand in hand. We all know the saying, the higher the risk, the greater the reward. And I have a torn relationship and view on this because I find this can be very misleading because many traders, people are led to believe that they should take large risk if they want to have a great outcome. However, in my mind, this is not what the saying implies at all. And the risk part is what people should focus on, not the reward part. And taking large risk means that you will fail most of the time. But every now and then you may get lucky and hit it big. But it is not guaranteed that if you take a high risk, that you will hit a big reward. Also, you cannot know when is the big reward coming up. You may hit it big after 50 tries when your trading account is already gone, or when it has shrunk to such a small number that even if you hit it big with a small trading account, it doesn't mean anything. And you may be about to hit it big, but you have been burned so many times before because you've taken so many high risk trades that you cannot capitalize on the potentially big winning trade because you screw it up along the way. You have no emotional capital. You are not brave enough, you're not confident enough because you have lost so many times taking the high risk trade that the big reward that is about to happen, you cannot capitalize in. You exit the trade before, you make wrong decisions along the way, and then you see that you could have made so much money on this one trade, but you screwed it up. You couldn't push it through that this will completely destroy your mental capital as a trader. So the higher the risk, the greater the reward. I would really urge you to get a different perspective on this. And if you really understand that the risk part is here where it's at, not the reward part, this will hopefully help you look at trading very differently. So the next step on our journey takes us to the connection between win rate and the reward to risk ratio. And in my trading, what I've seen is that this is probably the closest thing that we can talk about in terms of the holy grail in trading. And once you understand this, profitable trading is no miracle anymore. And this is a snapshot from one of the traders that we mentor. And he said this week he took 6 trades and he made 6R. And he was so surprised because he realized that with a 50% win rate. So he lost 3 trades and he made money on the other 3 trades and he ended up with 6R, which is pretty astounding. And this is, for many traders, the first aha moment in trading. Once they realize that what they have done in the past, mainly chasing high win rate systems, avoiding losses at all costs, that this is the wrong approach in trading. And this is not how you make money in trading. But once you understand that, that is where you get very, very close to becoming a long-term profitable trader. And the mistake that many traders make is that they want to go for a high win rate system while trying also to capture large winning trades. So you don't want to lose trades, and when you win, you want to win really big. And as we've learned when we talked about trade expression, how likely is the market to hit your target at certain levels, how likely is the market to hit your stop loss at certain levels, those two to reconcile, to have a high win rate and large winning trades, that's very hard, if not impossible. But the good news is that profitable trading does not require a high win rate and high and large winning trades at all. And when we look at it just in terms of pure 100% objective math, there's a relationship between the reward to risk ratio and your win rate. And there's a threshold that is the cutoff point where you become a profitable trader when you look at win rate versus reward to risk ratio. So for example, easy example, 50% win rate. What does it mean? Half of your trades you win, half of your trades you lose. If you have a win rate of 50% and your reward to risk ratio is 1:1, which means that you make as much money on a winning trade as you lose on a losing trade, that's your cutoff point. Because you lose half, you win half, and when you lose, you make as much as you win. So this is a break-even point. But if you go then one step further, if you have a system with a 50% win rate and a 2:1 reward to risk ratio, that's suddenly a money maker, because when you win, you make twice as much as what you lose when you lose a trade. For example, 10 trades, 5 winners, 5 losses. The 5 winners will make 10R, the 5 losses will lose 5R. You end up with a plus of 5R. That's a profitable money-making system. And the good thing is that you don't even need to be 50%. You could have a low win rate, even 30%, But assuming you have a reward to risk ratio of 4-1, you will make a lot of money. And you can follow this graph here on this line graph. You can see 40%, the cutoff point is here a little bit above 1.5. 30% here just a little bit above 2. And this is the good news. And this, when you realize that, I think this leads to a lot of aha moments. I have seen this many times in the past. When traders realize that what they have done in the past, chasing high win rate systems and trying to avoid losses at any cost, that this is the wrong approach. That's not the way to go. You can lose trades. You will lose trades, and there's no way around it. Don't fight that, but focus on the whole equation. Look at how much money you make when you win, how much money do you lose when you lose. And you don't need to make 10 times or 20 times as much money when you win a trade. This is not necessary at all. You make 2 times the amount when you win compared to when you lose. That's already a very, very good system. You make 3 times when you win compared to what you lose. That's an exceptional profitable system with the right win rate. And it doesn't have to be a high win rate. It can be a very low win rate. You can lose more trades than you win. And ask yourself, can you trade this? Is this realistic for you to achieve? Can you have a win rate of 30% while going for some reward to risk ratio between 3 and 4? Yes, most traders will be able to do that if you can overcome your greed responses, if you can really get into the long-term approach. And that is where I want to go to next. And this is a screenshot from Darwinex, and we have no affiliation with them, but realizing what this means, this is going to be the biggest revelation if you're trading. So Darwinex, what they do is very interesting. You can, if you're a profitable trader, even if you're not a profitable trader, you can publish your trading record and you can just show your track record there and trade with them, and other traders can invest into your trading. And I sorted the best trading systems by how much money was invested. And I want to focus on this one because this is also, I want to put a link to this in the video description. Etienne from Desire to Trade made an interview with the guy who traded this system and who is the founder and the trader behind this. Very, very interesting podcast interview. And he has, at this point in time, 10.7 million investors' capital. And he has a return of 650%. But 650% over 7 years and 9 months. And this comes down to an annualized return of around 28%. So per year, he makes 28%. And this is the second most followed and invested in trading strategy on Darwinex. And this is very different than what most traders try to make in their trading or try to hunt or what they are after, what their goal is. But ask yourself, would it be realistic to follow a strategy or to try to achieve a return of 28% per year? Can you do that? Most traders try to make 28% in a week. Some traders want to make that in a day. But if you shift your focus from this short-term gambling mindset to the long-term approach and really seeing what is really the difference between how professional long-term traders approach their trading and set this up versus social media short-term gambling, this is, I think, where you will never look back anymore. And this is really then the cure for all of your pressures, your mental struggles. Of course, 28% a year is not sexy in the short term. And if you make 28% this year, you will not suddenly have a Lamborghini. But you do this for 2, 3, 4 years, and then suddenly there's no limit to how much money you can approach and how much money you can trade and how much money people are willing to invest in you. And then this is where you get to where profitable trading is realistic and manageable and doable. And I know that a lot of you have concerns by watching the videos, and I want to address those now. Some people will say, but I've seen this guy on social media, on YouTube, on a podcast, who has a huge win rate. He has very large winning trades and he makes a lot of money. And again, we come back to the thinking in terms of probabilities. Wherever you look, there will be outliers. But using an outlier as your expectation goal, as your reference point, this will set you up for failure. and approaching your goals from the perspective of what's realistic, this will allow you to reach your goals much faster in a more reliable way. And the key here is that once you are successful with this realistic approach, you can still scale it up further later on, but don't try to run before you can walk. And I'm not saying that you should not have big dreams and you shouldn't shoot for the stars. You can, and probably you should. But before you can build a rocket to get to the stars, you maybe try to fix your bicycle first and see if you can ride around the block with it. And I think this cannot be understated, the importance of this. And this is something that I think is applicable to many other areas. People look up to Elon Musk, Steve Jobs, whoever has achieved extraordinary success. But this is survivorship bias. We don't see the millions of people who tried the same approach, who wanted to risk it all and then failed. We don't hear about them. We only hear about this one guy who made it and is now the richest man in the world. And we see that he took big risks to get there. And if you dig deeper, you will see that many times he was almost at the brink of not making it. And for every one of those guys, there will be millions and millions of people who don't make it. And of course, it is important to have big goals. But I would recommend and urge you take it one step at a time. And eventually, if you take it one step at a time, you will arrive at something that is really worthwhile, and you can still build this dream life that you want, but in a more realistic way without risking it every single day. It will also help you to remove a lot of pressures and just trade with a different mindset. So if we want to summarize the video with some key takeaways, we want to get to a point where we think in terms of sample size. We don't just look at one trade or two trades. We want to analyze and judge our trading based on 50 trades, 60 trades, 30 trades, at least a statistically significant sample size. Also, a single trade has a random outcome, and a trade outcome is independent from the one before. The trade quality is very important. Trade expression directly impacts the win rate. So how far is the target that you choose? How close is the stop loss? That impacts your win rate directly. And then the connection between the reward to risk ratio and win rate is the key to making money. This is really where you can see what makes a winning strategy. And that is so important. And having a realistic approach will help you become successful much quicker, and not even much quicker, in a more reliable way without a lot of pressure and stress. And what it takes to become a successful trader is for many traders within reach. And I've seen this many times, and I would really recommend that you take me up on my offer. Try this at least for the next 6 months, try it for the next 8 months, for the next year. Try to see how will this change your trading. Will it make it more stressful or less stressful? Will it make trading more manageable or less manageable? Will it have a positive impact on your trading and your life in general? I would recommend that you try it out, and I hope you watch the video until the end. I know that probably a lot of traders will not make it to the end of this video. If you did, you did yourself a huge favor. I would love to hear from you in the video comments if you made it to the end. So thank you for your attention, and until the next time.